Something impossible just happened. Something that defies every textbook on economics, every algorithm on Wall Street, and every expert prediction on CNBC. In the last 12 hours, while the world was sleeping and the mainstream media was distracting you with political noise, a staggering $297 billion of capital just flooded into the precious metals derivative market. Let me repeat that number so it sinks in. $297 billion. To put that into perspective, that is more than the entire market cap of Netflix. That is more than the GDP of Portugal. That is enough money to buy every single ounce of mined silver on planet Earth 10 times over. And yet, if you look at the spot price on your phone right now, what do you see? It moved at, 50 cents? $1? This is the smoking gun we have been waiting for. The systems are breaking. The price suppression mechanism that has held silver down for 40 years just took a direct hit from a kinetic financial weapon, and the gears are starting to grind. This wasn't retail traders buying coins. This wasn't a hedge fund rebalancing. This was a sovereign actor. This was a nation state hitting the buy button with the force of a nuclear bomb. Welcome back to the Prosper Path. Today we are going to dissect the single largest capital injection in the history of the silver market. I'm going to show you where this money came from. I am going to show you why the price didn't explode yet and why that is actually terrifying. And most importantly, I am going to show you why this $297 billion isn't an investment. It is a hostile takeover of the global monetary system. If you thought the squeeze was a theory, you are wrong. The squeeze just started and the first whale has officially entered the pool. I know exactly what you're screaming at your screen right now. John, if $297 billion just bought silver, why isn't the price at $5,000 an ounce? Why am I still looking at a $30 handle? That is the question that separates the tourists from the wolves. If you think that kind of volume hits the lit exchange, the public comex market where you and I can see it, you're dreaming. When a sovereign wealth fund or a central bank decides to corner a market, they don't log into a brokerage app and hit market buy. That would spike the price instantly and ruin their entry. Instead, they go to the dark pools. They go to the over-the-counter, OTC derivatives market. This $297 billion didn't flood into standard futures contracts. It flooded into notional swaps. Here's the mechanism they used to hide this transaction from you. The buyer approached the biggest bullion banks, JP Morgan, HSBC, Citi, and entered into a private total return swap agreement. Essentially, they said, here is $297 billion. We want exposure to silver. You hold the risk. We hold the upside. The banks, being the greedy pigs they are, took the deal. They absorbed that massive buy order internally. They didn't hedge it in the public market immediately because that would have sent the price vertical. They internalized the trade. They are betting that the price will stay low and they can pay the buyer in cash later. But here's where the banks just made the fatal mistake. The volume is too big to hide. Usually these OTC trades are hidden in the quarterly reports from the Office of the Comptroller of the Currency, OCC. But this order was so massive, so violent, that it triggered a liquidity alert on the interbank settlement layer. The plumbing of the financial system started leaking. We are seeing a notional explosion. The notional value, thus the face value of the contracts, has completely decoupled from the gross market value. This means the leverage in the system just hit a breaking point. The banks are now sitting on a $297 billion short position against a sovereign entity that has infinite pockets. Think about the physics of this. The entire annual mining supply of silver is worth roughly $20 to $25 billion. The single trade represents 10 years of global production bought in 12 hours. The banks have sold paper silver that doesn't exist, fast-forwarding supply from the year 2036 into today. So why didn't the price move? Because the spot price, you see, is a delayed lagging indicator. It reflects the public futures market. It does not yet reflect the private disaster happening on the bank's balance sheets. It is like a tsunami. The earthquake happens deep underwater, the OTC trade. The surface of the ocean looks calm for a while, but the water is receding from the beach. That is where we are right now. The water is pulling back. The banks are frantically trying to figure out how to cover a $297 billion hole without alerting the public. But they can't, because typically, these swaps have a 48-hour settlement window. That means by Thursday morning, this dark pool liquidity has to be reported to the clearinghouses. And when it hits the lit market, when the algorithms realize that the banks are naked short by $300 billion, the computer models are going to break. This isn't just a buy order. This is a liquidity trap set by an Eastern superpower to bankrupt the Western bullion banks. They fed them more capital than they could swallow, and now the banks are choking on it. So, who has the firepower to drop nearly $300 billion into a single trade? Let's use some basic deduction. This wasn't a hedge fund. Even the biggest funds like Bridgewater or BlackRock don't move that kind of capital into a volatile commodity without hedging it to death. This wasn't a tech billionaire like Musk or Bezos. This bears the unmistakable signature of a sovereign actor. We are looking at a nation-state operation. My analysis points directly to the east. We know the BRICS nations have been openly accumulating gold for 5 years. But this $297 billion move signals a strategic pivot. They have realized that silver is the Achilles heel of the Western financial system. It is the smallest, tightest, most levered market in the world. If you want to break the dollar, you don't attack treasury bonds. That market is too big. You attack silver. But here is the genius of their attack. They aren't just buying paper silver. They are using a mechanism called exchange for physical, EFP. This is the loophole that allows the banks to manipulate the price, but it is also the trap door that the sovereigns are using to drain the vaults. Here is how the EFP raid works. The sovereign buyer, let's call them with a dragon, buys a massive amount of paper contracts or swaps, that 297 billion figure we saw. The Western banks, the shorts, take the trade, thinking the dragon just wants to speculate on the price. The banks collect the fees and keep the price suppressed. But then the dragon flips the switch. Instead of selling the contract for a cash profit when it expires, they invoke the EFP clause. They say, we don't want your dollars. We want the metal delivered in London or Shanghai. This creates a massive problem. The banks sold $297 billion worth of exposure, assuming they would never have to deliver the actual metal. Now, they are legally obligated to find physical bars to settle that EFP demand. Where do they get it? They have to drain the LBMA vaults in London. They have to scrape the bottom of the barrel. This is why the price didn't explode yet. The transaction happened in the paper market, swaps, but the settlement is happening in the physical market, EFP. It is a stealth raid. The price on your screen stays low because the banks are desperately trying to keep it down while they scramble to find the metal. If the price spiked now, they would go bankrupt trying to buy the silver to deliver to the dragon. They are suppressing the price to save themselves, not to trick you. But every single ounce that leaves London via EFP is an ounce that never comes back. It goes into a sovereign vault in Shanghai or Moscow, and it is removed from the Western financial system forever. We are watching a bank run in slow motion. The $297 billion wasn't a bet. It was a withdrawal slip. So, here's the verdict. We have tracked the $297 billion anomaly. We have exposed the dark pool swaps. We have identified the sovereign predator using the EFP loophole to drain the physical vaults. The banks are currently in a state of absolute panic behind closed doors. They are desperately trying to source physical metal to settle these massive claims without alerting the public market. That is why the price is flat. That is why the news is silent. They are praying that you get bored. They are praying that you look at the chart, see nothing happening, and sell your position. Because every ounce you sell is an ounce they can use to pay off the dragon. You are their only lifeline. Do not give them that lifeline. What we are witnessing is the Wile E. Coyote moment of the Western financial system. The banks have run off the cliff. They are suspended in midair. The only reason they haven't plummeted to the ground yet is that they haven't looked down. But this $297 billion trade, that is gravity kicking in. Here's what comes next. When the settlement deadline hits, likely within the next 72 hours, one of two things will happen. Scenario A. The banks successfully manipulate the price down one last time to shake out enough retail paper to cover their physical delivery obligations. This will look like a flash crash. Do not sell into it. That is the final bear trap. Scenario B. They fail. They cannot find the metal. The EFP demand cannot be met. In this scenario, the exchange declares force majeure. They will try to settle the contracts in cash. They will say, sorry, we don't have the silver. Here's your fiat currency back plus a 10% premium. But a sovereign nation doesn't want cash. They want the asset. When the news breaks that the LBMA or the comex has failed to deliver on a $297 billion order, the trust in the paper system evaporates instantly. The price of silver won't just go up. The market will go no bid. That means there will be no sellers at any price. You won't be able to buy an ounce of silver for dollars anymore. You will only be able to trade for it with other real assets. Silver becomes unobtainium. This is why I scream at this camera every week. This is why the Prosper Path exists. We are not day traders trying to catch a 50-cent move. We are preparing for the inevitable mathematical collapse of a fraudulent paper derivative scheme. The $297 billion signal is the loudest warning shot we have ever received. The smart money has already positioned itself. The sovereigns have already bought their ticket. The only people left on the burning platform are the retail investors who are waiting for CNBC to tell them it is okay to buy. Do not be the liquidity for the exit scam. If you hold physical silver, you hold the only life raft that matters. If you're still sitting on the fence, look at the volume. Look at the flow of capital. The world is changing, and it is changing fast. I want to know who understands the magnitude of what just happened. Drop a comment below with, "I see the billions." If you know that the price is a lie and the squeeze is inevitable. Let the tourists sleep, the wolves are awake. Stay liquid, stay dangerous. And when the price resets, make sure you are on the right side of history.